Investment bank is large, complex, and has many standalone or connected departments. If you are interviewing for a role in investment banking, it is important to first get an overview of the major investment banking departments operating within an investment bank and the major roles within each department. Here is an overview of a typical investment bank structure. Let's go through each of the divisions so you have idea on how each division differs. Senior management. At the top of the pyramid we have senior management. Senior management includes the CEO, CFO, and others who run the entire firm. Investment banking. Investment banking is a group within the investment bank itself. The investment banking group is typically broken up into coverage, mergers and acquisitions, and capital markets. Coverage. Coverage is a core investment banking department that is divided into industry groups. Industry groups include technology, media and telecom, also called TMT, real estate, and industrials are good examples. The role of these groups is to go to clients within the particular industry and sell investment banking products. These banking products are aimed to drive growth in the client's business. These products are most likely mergers and acquisitions and capital market underwriting. So if you were a managing director within one of these groups, you would be responsible for covering several companies within the industry group. The role would be to sell some M&A or underwriting business to said client. Most often presentations pitch books are created as a tool to help pitch or sell business. An analyst would be responsible for researching the data for slides that would populate the presentations. These slides may require some analyses such as financial modeling, valuation, in addition to market research. If the client expresses further interest in one of the products mentioned, then the coverage team would coordinate with the respective product team. For example, if the client expressed interest in raising equity, a subset of underwriting, then the coverage team would coordinate with the equity capital markets team to further the potential transaction. Mergers and acquisitions. This is probably the most sought after group from a junior perspective within the investment banking department, primarily because it's the most financial modeling intensive. The goal of the mergers and acquisitions group is to aid in advising clients on the potential merger or acquisition of another asset or corporate entity. Mergers and acquisitions is a general definition that often also applies to divestitures and other types of restructurings. Although some banks separate restructurings as another group. If a client is interested in acquiring or divesting all of or some part of their business, the M&A team is assigned to work on the transactions. The analyst will be responsible for modeling the financial impacts of the transaction in addition to drafting documents, setting up conference calls, and other process-oriented tasks. But it is the M&A modeling exposure that is typically most desirable for a junior analyst. This technical know-how opens doors to other career paths such as private equity and hedge funds. Capital markets. Capital markets is typically subdivided into equity, debt and convertible. Capital market groups aids in the process of raising capital or trading securities for a client, be it equity, debt, convertible securities. So if a client, for example, had expressed interest in raising equity, the coverage team would pair up with the equity capital markets team. The equity capital markets team would advise the client on the types of equity securities that could be raised based on various market conditions. They would advise on how much equity could be raised given the nature of the markets, and a recommended type of security to get most value for their equity. This takes years of experience and a strong understanding of the markets. Investment banks depend on these managing directors to give good guidance based on market conditions, and follow up with their recommendation when it comes time to actually issue said securities. In these groups, the analyst would be responsible for populating the presentation slides, which entails data mining, market research, and some modeling and analysis. But again, the modeling would not be as intensive as in the M&A group. Actually, it's sometimes known that the capital markets groups are the least intensive. This can be a benefit for those who want to get into the investment banking industry but are not interested in working 100 hours or more. On the other hand, the less intensive groups don't always get the attention of the premium private equity and hedge funds. Sales and trading. The sales and trading department is outside of the investment banking department. Salespeople and traders are responsible for the selling and trading of investment securities. So, for example, if a client was in fact interested in raising equity as per the advice of the equity capital markets managing director, the sales and trading team would be responsible for the execution of said security. The sales process begins with calling potentially interested investors and other institutions about securities such as hedge funds and mutual funds. When the time comes to sell the equity, trading begins. Nowadays, this is done via computers as opposed to the yelling and screaming you may see in the movies. An analyst in the sales and trading group would likely maintain records of trades and the portfolio positions. They could also be responsible for calling potential investors and over time executing the trades. Hours are generally limited to market open and close, in addition to some early morning meetings, and possibly some after-market analysis, but certainly not the 100 hours or more demanded in the investment banking groups. Equity research. The equity research department is responsible for providing written reports, demonstrating the expected valuation of a stock based on the opinion of the Wall Street analyst. These reports are sold to clients and funds, among others, who are interested in the analyst's stock expectations. The equity research department is also divided into sectors, just as the coverage group is. As a junior analyst, one would be responsible for constructing and updating models resulting in stock valuations. Working in the equity research department entails modeling and valuation. However, it is important to note that often the type of modeling performed is not as robust as the investment banking type of modeling. On the other hand, another positive point of being in the equity research department is that one would get specific knowledge of an industry, which can come in handy later in one's career. The hours in the equity research department are significantly less than in investment banking. Weekends are generally free, and a junior analyst is often out by 7 at the latest, except for the quarterly and annual earning seasons, when all models need to be updated based on company performance results. Asset management. Asset management helps manage the client's assets and investments in certain securities. Clients typically include high net worth individuals in addition to other institutions. Asset managers diversify a client's portfolio by investing across different asset classes, including equity, fixed income, and derivatives.